two people apply for a loan on the same day. They both ask for the same amount of money. One application is approved within minutes. The other application is rejected without any explanation. Both outcomes are produced by a decision process they never see.
A loan decision begins at the exact moment an application enters the bank's system, whether it arrives digitally or in person. Customers may submit this application through a mobile banking app, an online form, or directly at a physical branch. At this early stage, no bank employee is deciding anything based on opinion or personal interaction. The system is designed to ignore emotions, explanations, and intentions provided by the applicant. Its first responsibility is to identify the type of loan being requested by the customer. Personal loans, home loans, and business loans are treated as completely different financial products. Each loan type follows its own predefined rules, timelines, and acceptable risk boundaries. After identifying the loan category, the system assigns the application to a specific processing path. The application is then placed into a structured queue that controls when it will be reviewed. From this moment forward, the movement and handling of the application are governed entirely by system logic.
Before any risk or repayment analysis begins, the bank must confirm the identity of the applicant. This step is required by law and is designed to prevent fraud, money laundering, and illegal access to credit. The system checks government-issued identification documents provided during the application process. It also verifies personal details such as name, date of birth, and current address information. These details are compared against internal records and external verification databases. The system then checks whether the applicant appears on any sanction or restriction lists. If a match is found at this stage, the application is automatically stopped. After identity confirmation, basic eligibility rules are applied to the application. The system checks legal borrowing age, residency status, and minimum income requirements. Only applications that fully satisfy these mandatory conditions are allowed to proceed further.
After identity and eligibility are confirmed, the bank evaluates the applicant's credit history. Credit history represents how the applicant has managed borrowed money in the past. The system requests credit reports from external credit reporting agencies. These reports contain records of previous loans, credit cards, and repayment behavior. The system checks whether payments were made on time or missed repeatedly. Defaults, write-offs, and serious delinquencies are identified and weighted heavily. The total amount of existing debt is also reviewed as part of this step. The length of time the applicant has been using credit is taken into account. All of this information is compared against historical data from similar borrowers. Based on these comparisons, the system produces a credit-based risk assessment.
After credit history is reviewed, the bank focuses on the applicant's current income and cash flow situation. Income data shows whether the applicant can realistically repay the loan on an ongoing basis. The system collects salary slips, tax records, and bank statements submitted with the application. For self-employed applicants, business revenue and cash inflow records are examined instead. The stability of income is analyzed, not just the total amount earned. Regular and predictable income is treated as less risky than irregular or seasonal income. The system identifies fixed monthly expenses, such as rent, utilities, and existing loan payments. These expenses are subtracted from income to calculate available cash for repayment. A debt-to-income ratio is then calculated to measure repayment pressure. If this ratio exceeds predefined limits, the application is flagged as high risk.
After income and affordability are evaluated, the bank assesses whether the loan requires collateral or security. Collateral is used to reduce potential losses if the borrower fails to repay the loan. For secured loans, assets such as property, vehicles, or savings accounts are reviewed.
The system confirms that the applicant legally owns the assets being offered as collateral. It also checks whether the assets can be enforced or liquidated under banking laws. Market value is not treated as reliable for risk purposes. Instead, the system estimates a conservative liquidation value under stressed conditions. This value determines how much risk reduction the collateral actually provides. If collateral coverage is insufficient, the loan risk remains largely unchanged. Collateral can reduce risk exposure, but it never guarantees full protection for the bank.
After credit, income, and collateral information are collected, the bank combines all data into a single risk evaluation process. This process relies on predefined risk scoring models used across the entire institution. The models are built using historical loan performance data collected over many years. Each variable, such as income stability or repayment history, contributes to the final score. The resulting score represents the probability that the applicant may fail to repay the loan. This score is numerical and does not include emotions or personal interpretation. The bank defines clear approval and rejection thresholds around these scores. Applications below the lower threshold are automatically approved by the system. Applications above the upper threshold are automatically rejected without human input. Scores that fall between these limits are flagged for additional review. Even when an application meets credit and risk requirements, the bank must still apply regulatory and internal policy constraints. Banks operate under strict financial regulations designed to protect the stability of the financial system. These regulations limit how much risk a bank can take at any given time. The system checks whether approving the loan would exceed capital or exposure limits. It also evaluates concentration risk within specific industries or geographic regions. Internal bank policies may further restrict lending to certain customer categories. If any regulatory or policy rule is violated, the loan cannot be approved. At this stage, profitability or customer history does not matter. No employee is allowed to override these constraints. Regulatory compliance always takes priority over individual loan outcomes.
Not every loan application is finalized entirely by automated systems. Some applications fall close to approval or rejection thresholds and require human review. These cases are escalated to trained loan officers for further examination. The officers review contextual details that automated systems cannot fully interpret. This may include recent job changes, temporary income disruptions, or unusual financial events. Human reviewers must follow strict guidelines when assessing these edge cases. They are not allowed to ignore system results or apply personal preferences. Any adjustment or override must be clearly justified and documented. Each human decision is logged for internal audit and regulatory review. Human involvement exists only to resolve exceptions, not to replace the system. Once a loan is approved in principle, the bank must still decide the final pricing and terms. Loan pricing determines how much the borrower will pay over time for access to the money. The system adjusts interest rates based on the level of risk identified earlier. Applicants with lower risk scores are offered lower interest rates and better terms. Applicants with higher risk scores are offered higher interest rates to compensate for uncertainty. The system also considers loan duration, repayment frequency, and loan amount when setting terms. Pricing decisions must balance profitability for the bank with affordability for the borrower. If loan terms are too expensive, the likelihood of default increases. If loan terms are too generous, the bank absorbs unnecessary risk. The final pricing reflects a calculated trade-off between risk, return, and sustainability. After all evaluations, checks, and pricing decisions are completed, the bank issues the final loan decision. This decision is generated by the system based on all prior rules, models, and constraints. The outcome is binary and leaves no room for negotiation at this stage. Applicants are informed of the decision through digital channels or direct communication.
An approval message confirms the loan amount, interest rate, and repayment terms. A rejection message usually provides limited information due to legal and policy restrictions. No single employee is responsible for the final outcome of the decision. The result reflects the combined effect of system logic applied consistently at scale. Millions of loan decisions follow this same structured process every year. At this scale, banks are managing risk portfolios rather than judging individual people.
A loan decision is not personal and is never made by a single individual inside the bank. It is the result of structured rules, risk limits, and systems designed to operate at scale. Understanding this process explains why banks focus on consistency and stability rather than individual stories.